Stay on the line, caller.
A trade on GDP. Yes, stay on the line, caller. You're managing a GDP trade this morning. So we had a GDP announcement this morning. Rises at a 2.8 rate. The estimates had been for a 3% rate of expansion. We didn't hit it. So this was a disappointment, although it's not what we would consider a huge disappointment. We pretty much hit on target, just a little lower than what people wanted. But 3% is considering the world economic environment, is not bad. So what was your perspective on the whole thing?
Well, I honestly thought, I mean, the previous was 1.8, so I honestly thought if it came anything over 2 that it would be seen as positive news, even though it was expected at 3. But as soon as that news came out that it did not hit the target, the markets dropped pretty hard. I was watching the E-mini S&P, and it was trading, it was trading above 13.15, right about 13.17, I think, when the news came out. Right now we're at 13.09. The low since that has been about 13.07, I think. So it has come down because it missed. Of course, if you were watching earlier this week, there was a huge rally in a lot of the markets after Ben Bernanke promised to keep throwing gasoline on the fire. But yeah, I think that even though there was an improvement, everybody was really hopeful that we would see that 3.0, but we did not, and it dropped pretty hard. I was surprised to see a 2.8 drop that hard.
Yeah, it's strange considering 2.8 is not a bad number for our GDP increase. The rest of the world is having a really hard time. It's strangely enough, we're doing better than the rest of the world. So, except for China. China's beating us. Bunch of bastards. But it's, so a 2.8% increase in our GDP is actually pretty positive. We're heading in the right direction. That's a good sign. So let's just keep up with that. Now, it didn't exactly meet everybody's expectations. Now, another thing to consider with the future, with the drop in the market we're looking at right now, we're looking at an across-the-board drop of about 0.5%. S&P is down 6.75, Dow is down 57, NASDAQ is down 13.50. All of those are about 0.5%. It's not surprising we're having a down day today. If you look at the last couple of weeks, we've had a very solid rally. Now, rallies peter out. Rallies overshoot. Realistically, where should the market be? Probably a little less than it is right now. So having a pullback is not a surprising thing. In fact, we should probably have had that on our radar as something that was likely to happen at some point. I forget what economist said it, but basically, if something can't go on forever, it won't. And that's what we're looking at with the market, is the rally, this little mini rally we're in can't go on forever. Now, back at the beginning of the month, we talked about January effect, things along those lines. January effect is the concept where if January has a good, solid, profitable month, an increase in value across the markets, that sets the tone for the entire year. We had a good, profitable month. I mean, we're coming up near the end of January. We're going to be closing the month out shortly, and it was a good up month. So what's that going to mean? Don't know. I mean, is the January effect anything that's an absolute? Definitely not. But what that says is that there's going to be people looking at that thinking this may run for the rest of the year. We may see the markets coming back, and the markets do have plenty of room to come back. So, our bias may be a little bit positive. Now, doesn't mean we don't have some risks out there. We've still got the issues of Greece trying to sort out all of its debt. It looks like things are coming together there. Not great, but it is. They are working on it, and that's a positive thing. It seems like there's some breaks in that. Let's see.
Inflation is a risk
Yeah.
at the moment.
Inflation,
I
yeah,
think
inflation is a risk. What's that?
I've said it a few times. I think the only reason inflation here in the U.S. is not worse than it is because people are still flocking to the dollar. It's still the best currency out there. Where
Yeah.
else are you going to go? Were it not for that one key fact, the dollar would be a lot worse off, and our inflation would be even more serious than it already is. And then, of course, that would start to affect the GDP, and it would affect employment even more than it is right now.
Right. Right.
But that's definitely our risk here is inflation.
Right. And Bernanke is committed to not raising the interest rates until 2014, and people are also speculating on it not changing until 2017. So I guess we'll see what happens there. Now, bluntly, if we do start seeing signs of strong inflation, the PPI, CPI numbers start going up significantly, then they will raise interest rates no matter what they've said. One of the biggest fears that any central economist has, any central banker has, is that the interest rates are going to go through the roof. Number one reason for that is that the banks all have all these loans out there that they're getting a certain interest rate on, and if inflation goes up, excuse me, I was talking about inflation, not interest rates. If inflation goes up, it devalues all the money in those banks, and it devalues the money that these banks have coming in on these loans. Big, big risk for them. But it's also one of the best ways of getting rid of the national debt, because you still have the same number of dollars on national debt. It's just not worth anything. It's a real interesting game. But in general, in the world, inflation is considered a very bad thing. You want to keep it at a moderate level. Now, funny thing is, you don't want it to be zero, because that's also bad, and you definitely don't want deflation. Deflation is when the ability of companies to price things goes down. They can't get their customers to buy. They've got excess production capacity, and they can't get people to buy things at a decent rate, so they have to sell them at a lower rate, and the value deflates. That's a horrible situation. That's uncontrollable, and we want to be very careful of that. Now, biggest place that has a risk of that right now is China. China has a massive amount of production capacity. They've probably had a little bit of a bubble in their production capacity, and they're having some situations over there where their economy is very, very on a very, very dangerous edge. Lots of bubbles are coming together at the same time and looking like they're going to pop in China. So we need to be careful. There's another risk on the horizon. China has not gone away as a problem. They also have a massive amount of loans in this kind of black market loan system over there that are extremely, extremely high rates. Talking like loan shark rates here, 30-40% a year for houses and things like that. Their internal banking system does not work for the consumer. And so the consumers have built up a banking system of their own that's unregulated. That whole thing could fall apart. If China has a massive failure in its economy, we could have a lot of that effect hit us here. Just be aware of that. We're very, very tightly tied to the Chinese economy now. Strangely enough, they're actually buyers of a lot of our things. We think of ourselves as mostly an importing nation. The net trade balance is skewed heavily towards us importing, but we do sell to a lot of these other countries. We do sell products to China, and if China starts failing, our markets start going away, and we don't want to see that happen. Just a couple of things to keep on the radar for what's going on out there, and just be aware. Nice thing is, I don't see any specific risks popping up in the next couple of weeks. I don't see anything on the radar that's overly worrisome. We've got Davos going on right now in the World Economic Forum. That's always an interesting little thing to watch. It's it's more of a chance for all the world economists to spout off and blame each other for the problems. Um, Geithner is going and pointing at the relationship with China, pointing at the problems in Europe. We probably ought to point at ourselves a little bit. We're not exactly in the best financial situation. Let's see here. Other than that, anybody have anything on the radar? Anything that's that we should be talking about?